Welcome to today's explainer. Now, we are going to be looking at a massive and honestly, largely unrecognized threat to your retirement architecture. We spend our entire working lives hyper-focused on things like market crashes, recessions, daily volatility. But the data is actually telling us that the absolute greatest threat to your long-term financial security is something completely different. It's a structural vulnerability known as the portfolio black hole.
Okay, let's dive right into this, because the numbers here are staggering. If you're planning for a standard, traditional 20-year retirement, you have a 40% mathematical probability of outliving your money and going completely broke. Think about that for a second. Nearly half of the people planning for a standard 2-decade retirement are going to face late-life insolvency. That's a terrifying coin flip.
To really understand why this happens, we have to look at this brilliant metaphor from Swedish investing literature. Think of your entire financial life like a massive mountain. Now, the accumulation phase, your working years, that's the climb up. It's all about saving, building the asset pile, taking risks, and maximizing growth. But the decumulation phase, retirement, that is putting on the skis and heading back down. And the skills you use to climb up are entirely different from the skills you need to safely navigate that slope down. On the descent, it's really not about the total size of your assets anymore. It's all about income, cash flow, and risk mitigation.
So here is our roadmap for today's explainer. First, we'll cover the portfolio black hole, then the average expectancy trap, followed by the 90-year-old math. After that, we'll get into sequence of returns risk, then we'll be recalculating safe withdrawal rates, and finally we'll wrap up with concrete strategies for longevity mitigation.
Starting with Section 1, the portfolio black hole, also known as longevity risk. In strictly mathematical terms, this is simply the probability that you will outlive your liquid assets. Now, the TIA Institute recently identified this fascinating and dangerous disconnect in digital search behavior. There is just massive engagement, incredibly high search volume for general retirement planning. Essentially, everybody wants to know how to build the pile. But there is conspicuously low volume for longevity risk mitigation. And that right there is the missing alpha in the market today. It's the decumulation strategy. It's figuring out how to not run out of money. People are so obsessed with filling up the bucket that they are completely ignoring the mathematical hole right at the bottom of it.
Moving to Section 2, the average expectation trap, or why we are planning too short. This hole in the bucket is primarily caused by what researchers are literally calling a longevity literacy crisis. So, here is the brutal truth of the matter. Approximately 90% of investors out there use average life expectancy as their primary planning anchor. Now, for a 65-year-old man, the average is roughly 84, and for a woman, it's about 86. But mathematically speaking, planning for the average is literally a 50-50 proposition for failure. I mean, by definition, half of the population will live longer than the average. If you plan your money around the average age, you are flipping a coin on whether you'll be destitute in your final, most vulnerable years.
Let's look at the actual actuarial data from the Society of Actuaries, because this is eye-opening. If you look at a healthy 65-year-old couple, they have a 70% chance that at least one of them will reach age 85. But even more shockingly, they have a 47% probability, that is basically a coin flip, that at least one spouse will reach age 90. Reaching 90 is no longer some rare statistical outlier. It's a highly probable reality, but it's one that most standard financial planning software just completely ignores.
Which brings us to Section 3, the 90-year-old math, or what we call the silent eraser. Because surviving to 90 or 95 introduces us to the absolutely massive compounding threat of inflation.
Let's break down the 90-year-old math. If you retire at 65 with a $1 million portfolio, and we assume just a very modest 3% annual inflation rate, by the time you reach age 95, the actual purchasing power of that $1 million has been eroded down to just $400,000.
You can see the mathematical erosion clearly over time here. At year 30, your purchasing power has dropped by nearly 60%. And you know what makes this even worse? Standard inflation doesn't even tell the whole story. The Bureau of Labor Statistics actually tracks something called the CPIE, that's the Consumer Price Index for the elderly, and it heavily weights things like healthcare and housing. In your final decade, say from 85 to 95, uncontrollable healthcare costs just skyrocket. You can't exactly clip coupons for private nursing care, right? So your actual personal inflation rate during those years might be 5% or higher, which just rapidly accelerates the drain on your remaining assets.
This takes us to Section 4, sequence of returns risk, the retirement red zone. because compounding that inflation problem is a very specific mechanical danger.
Now, what's really interesting about this concept of the retirement red zone is how unforgiving it is. When your portfolio experiences a major crash early in retirement, and you are forced to sell off assets at depressed prices just to pay for everyday things like groceries, electricity, property taxes, you are permanently damaging your portfolio. Those shares are gone forever. They literally cannot participate in the eventual market recovery. And doing that accelerates your path right past the point of no return, straight into the portfolio black hole.
Just to anchor this theoretical risk to a brutal historical reality, think back to the dot-com crash. Analysts noted that the Nasdaq Composite lost 85% of its value. Imagine retiring exactly then, relying on regular monthly distributions without any cash safety buffer. That lack of control during a major, prolonged crash was just absolutely catastrophic for people's retirement survival.
So, Section 5, Recalculating Safe Withdrawal Rates. How do we update the math to fix this? We have to transition into some technical solutions. For decades, the gold standard in the industry has been the famous 4% rule. But here's the catch. That rule was designed for a 30-year horizon. We have to update it for a modern 40-year lifespan.
Let's see how this actually builds out based on recent data from Morningstar. If you want a 90% probability of success, a 30-year horizon safely allows a 3.9% withdrawal rate. But if we extend that survival horizon to 40 years to account for extreme longevity, taking a 65-year-old all the way to age 105, the mathematically safe amount you can withdraw drops down to just 3.3%.
The contrast here is just incredibly stark. The 20-year gamble lets you take out over $50,000 a year on a $1 million portfolio, sure, but it leaves you with that 40% chance of failure we talked about. If you take that higher payout early on, you are seriously risking being completely destitute right at age 90, exactly when you might need to pay for expensive private nursing care. On the other hand, the 40-year reality drops your income to $33,000 a year, but it mathematically ensures your survival. That roughly $22,000 difference in annual income, that is the price of certainty. Finally, Section 6, Strategies for Longevity Mitigation. How do we close the black hole? Because thankfully, living on a permanently restricted, reduced income isn't the only option. We can use actionable structural hedges that professionals use to entirely remove longevity risk from the table. One highly technical and frankly very underutilized tool is the QLAC, the Qualified Longevity Annuity Contract. Thanks to the Secure Act 2.0, you can now take up to $210,000 of pre-tax funds straight from your IRA at age 70 and buy a deferred annuity. It defers your taxes, which is great, but more importantly, it guarantees a massive cash flow starting later in life, say at age 80 or 85. It acts as an absolute unbreakable backstop for your oldest years. It's essentially longevity insurance. You are buying the peace of mind that no matter what the stock market is doing, a guaranteed income stream is going to activate exactly when you need it most. And this brilliantly illustrates the current opportunity. Because we are in a relatively high interest rate environment right now, the payout advantage of annuities is massive. The standard 4% rule gives you $40,000 a year on $1 million. But if you transfer that longevity risk to an insurance pool via a life annuity, you can currently guarantee over $53,000 or even up to $57,000 with loyalty bonuses every single year for the rest of your life. It creates an incredibly solid income floor that you literally can't outlive. Now, for the rest of your portfolio, professionals use time segmentation. You'll often hear this called the bucket strategy. It's pretty straightforward. You keep 1 to 5 years of living expenses strictly in cash or short-term CDs. This is your immediate bucket. It's your buffer against sequence of returns risk. If the market crashes tomorrow, you spend this cash instead of selling off your depressed stocks. Then your intermediate bucket, covering years 5 through 15, holds bonds and fixed annuities for steady, reliable income. And finally, your long-term bucket, designed for years 15 through 40, stays aggressively invested in equities, because you absolutely need that aggressive growth engine to fight off that 30-year 60% inflation erosion we analyzed earlier. So, to sum this all up, wealth accumulation was all about the climb. It was about building a massive pile of assets. But decumulation, that is all about control on the way down the mountain. It is about actively ensuring your financial bucket does not have a mathematical hole at the bottom of it.
I want to leave you with this final, truly vital thesis from the research we've looked at today. The biggest risk to your wealth isn't a market crash. It is the biological success of living too long.
So I want you to look at your own retirement architecture right now.
Are you just flipping a coin and hoping you won't outlive the average expectancy? Or are you building a concrete mathematical plan to ensure your wealth span actually matches your lifespan? Take the time, do the math, and close the portfolio black hole.